Good afternoon, everybody. This is Mike Flaherty with Alpha Centric, and welcome to this month's Riffin on Real Estate call. I'm joined here this afternoon with Brian Liu, who is one of the portfolio managers of our IOFIX, the Income Opportunities Fund. Brian, thanks for joining us here this afternoon.
It's a pleasure. Thanks so much, Mike.
Brian, it's kind of interesting. You pick up the Wall Street Journal this morning, it talks about, and I'm sure everybody can see this real well, but still, bonds having their best year since 2020. But yet, I kind of look out there and, it seems like there's some nervousness. You look at what happened with Tricolor here recently. That was kind of a high profile situation. Same thing with First Brands. And yet, people, that may not really understand what we kind of feel is the opportunity in this whole legacy non-agency RMBS space. So kind of walk us through that a little bit, and we'll look forward to having a nice discussion.
Oh, thanks a lot. I think a lot of the corporate situations, the two you just mentioned, plus a lot of different blurbs and discussion about private credit and where it's headed and what happened and or why it was so popular. And I think in the last 4 years, since we've seen rates rise and there be so much focus on inflation and all that stuff, certainly at the end of last year, as we started seeing light at the end of the tunnel with some of these rate cuts, it's almost as if now people are kind of realizing that many people are trying to boost returns or get other returns or alternative returns, go into alternative asset classes because of the carnage that they've seen in regular fixed income. And so as people maybe got overextended on some forms of credit, or as they situations like this where you could say it might be a one-off, or it might be, as Jamie Dimon said, the first cockroach is coming out, so to speak.
Yeah.
I think a lot of that is probably still yet to be revealed, right? But I think in more traditional forms of fixed income and good old-fashioned treasuries, and as you mentioned, and something that we really like in non-agency and in particular legacy mezzanine bonds, we think that there's a lot of opportunity. One of the biggest things for a lot of the securities that we like is this notion of excess spread. And that's where borrowers have been paying this rate. And for most of these legacy borrowers, they're kind of 15, 20 years in this mortgage. They weathered the financial crisis. They're still around. They have a lot more equity in their homes, on the order of 60% equity. But the rate that they're paying, right, that they've been paying for so long, ostensibly is a lot higher than the coupon rate of the bonds that own that mortgage and that are backed by that mortgage. And so what we've seen in particular this year is that at the end of last year, when the first round of rate cuts came into place, is that lowered the coupon on the bonds because they're mostly floating rate. Okay, and so you think, well, that's worse, is lower coupon. But actually, for a lot of these securities, one of the biggest features is that when the bond coupon is lower, and yet you have the amount being paid in by the borrower at about the same rate, that increase in the difference is called excess spread. It's a higher excess spread now that less money is going to be paid toward the coupon. And that excess spread can be used to repair that bond, right? If that bond has prior losses, or if there had been shortfalls in some of the interest over the last couple of years when rates have been high, a lot of these things are going to start to get recaptured by those bonds. And so throughout most of this year, in effect, because of the cuts that we saw last year, a lot of that higher excess spread is filtering through to these bonds now. And so we've been seeing just a great recovery and a great rally in these securities. And as we've had 2 more rate cuts at the end of this year already, and obviously December is now in play, we think a lot more of that is to come. And remember that when these rate cuts, now that they're in place, it's not like we needed those just to occur one time and we get like a one-time shot in the arm. That lower coupon rate is leading to higher excess spread on an ongoing basis. And that ongoing basis is what's going to keep making these bonds be able to recover more and recover shortfalls. And as I mentioned, write back a lot of value on the security. So we really like the setup for this bond going into the end of this year and into next year and the next few years.
So Brian, it sounds to me like and for our listeners, that's really a function of the fact that the mortgages are fixed. So the borrowers have a fixed rate mortgage, but it's the floating rate coupon nature of the bonds that kind of creates this excess spread that you're talking about. So when rates were moving up, that spread was getting squeezed and there wasn't as much there. But now that rates have been ticking downward, that spread's increasing and is helping us to be able to repair some of these past prior losses. Is that a fair characterization?
Yeah, that's really well said. I think, and the idea that these borrowers are in fixed rate bonds, I think it's a much higher percentage now that are in fixed rate, so it might not be 100%, but still, the borrower average coupon being paid in or average interest rate being paid into the trust is effectively fixed or just about fixed. Whereas, with these rate cuts, the coupon has definitively dropped.
Okay, that's very good. So where just in kind of a general sense, where are these bonds sort of trading at right now, relative to other things in credit?
Sure. It's funny because I think a lot of people pointed to how IG spreads and high yield spreads have maintained, pretty good levels throughout the last several years. And so kind of why has that stuff been able to uh, maintain, its level or just not sell off as much, and in fact, kind of maybe rally even into the last couple of years, whereas things in RMBS and in our legacy space have continued to kind of be really soft or not widen. And so I'd say we're still a good, you know anywhere from 100 to 250 plus basis points wider than kind of your comparable assets in those unsecured corporate product spaces, right? And so here we're talking about getting much more spread along with having an actual collateralized obligation, right? Because of this home that, as I mentioned earlier, has arguably 60% equity in the home, right? So the coverage on the loan is that much better now as well.
So because we're talking about legacy, basically, stuff that was originated in 2008 and earlier. uh, the average borrower in this space has been in their home for 15, give or take years. So which really kind of fortifies their credit position. So talk about what it looks like going forward for the next you know 8, 10, 12 years, given the fact that, these folks are in there with pretty low mortgage rates right now. And, rates are still pretty high. Just kind of talk about what the go forward looks like for this space.
Sure. I think a lot of these borrowers, because you call them very seasoned borrowers, they've been in that home for a long time. And in fact, during this entire time that they've been in the home, they probably had, a handful or several chances to refi. And the fact that they didn't, you kind of think, well, why didn't they do that? In some cases, it could be because their loan balance was low enough that, the change in payment wasn't going to be, material enough for them to start trying to get their documents together and all that, right? There, if you think about it in the very first place, because as you mentioned, they got their loan before the crisis. A lot of these borrowers had limited documentation, or they might have been small business owners or something where they had to get a kind of a non-traditional credit product, right? And so for them to be able to refi was still going to be, somewhat more of a difficult task for them than it might be for someone just going with a conforming loan. And so they have not refied over the last, again, 15, 20 years, where they had better opportunities in terms of rates. So it seems at this point that they're probably still likely to keep the rate that they've had. They're much more into the principal portion of the repayment now,
Right.
so to speak. And so for them, they've got much more equity in their home. They've been doing it for a long time. That loan is kind of more a part of their regular life, and the servicing of that loan is part of their life now. And so we don't anticipate a whole lot in the way of prepays, but in a very similar sense, in a good sense, we don't anticipate a lot more in the way of foreclosures or defaults, right? So at this point, this borrower having kind of proven themselves in terms of being a seasoned borrower for this long, we don't anticipate just a lot of big changes in a lot of the profile of these borrower payment patterns or how they go forward. And I think having that be a little bit more steady, so to speak, or at least having maybe a little bit more protection or mitigation from the seasonality, I think that allows us to get a better idea of the profile of the bonds going forward as well.
Okay, very good. So just to kind of, put a bow on this, then you're talking about an underlying borrower that's been in their house for 15 years. Uh, plus, refinancing, yeah, people get divorced and people move, but beyond that, why would you give that up? So
Right.
you've got a really strong underlying borrower. Um, you've got bonds that are still trading in kind of the, just say, 80, ish, type price. So you've got over the next few years, you can pick up a yield in the high sevens, eight kind of handle, plus another 2 to 3 on top of that per year on average. It's not linear, as we
Yeah,
know, but
sure.
on average over the next few years, as these bonds slowly accrete to par, and that doesn't really even account for a lot of the loss write-backs as a result of the excess spread. Is that kind of what I'm hearing here?
Yeah, that's exactly that's I think that's a good way to characterize it, is that you're getting great current yield now with this kind of pull to par because a lot of them are still at a discount. And then this feature that you mentioned about write backs, I think is really specifically a feature to this legacy subprime mezz space. Because a lot of the bonds took write downs, whether it was in the GFC or even in more recent years. I mean, some of them even take write downs now. But the fact that you're getting reductions in principal and yet you have the excess spread now increasing and turning on, a lot of that can be almost, if you think about it, it's kind of reapplied to the principal, right? So that you're going to be able to repair the bond and get principal back that you can lay claim to because you had it written off in the past.
Right.
Okay, and so in that sense, we like to describe these bonds as getting you back more than par, right? Because we buy it at a certain size and a certain current face, and if we end up getting some of the prior losses written back, right, and we end up getting more current face back in maturity, then we're getting in effect more than par back.
Great. Brian, let's leave it there for now. We appreciate everybody joining us this month for our real estate call. There's nothing more germane to real estate than what's going on in the mortgage-backed securities world. Everybody's got a mortgage. At least most people do, although the average home buyer is moving up into the 40-year-old space, I just read. But we thank everybody for joining us. Brian, thank you. And we'll look forward to seeing everybody again next month. Until then, I'm Mike Flaherty.